After 20 years in real estate investing, I've kind of seen it all. Market crashes, skyrocketing prices, bad tenants, great deals, and even a few disasters. If I had to start over again today, here are 3 of the biggest lessons I wish I knew from day one. Whether you're a new or experienced investor, these could save you from some expensive mistakes.
Look, I get it. The Toronto real estate market is confusing. Whether you're a new or experienced investor or just looking for a home to raise your family in, join us at Broadview Table Talks as we sit around the table with my friends and talk about the real estate and the ever-changing market in Toronto.
Lesson number 1, cash flow is king. Early on, I focused too much on appreciation, assuming values would always go up like many other investors do. And I know some of you guys are smart out there and laughing at all of us that are kind of seeing the prices go down now. We had a blip in 2008 when we had a global financial crisis. That was small at the time, relatively. It bounced back like within 6 months, but we've never seen a crash like this unless you're around investing in the 80s or 90s. This somewhat feels like that is from what I'm hearing. Is lots of investors fall into the trap of speculation, buying properties purely based on the expected future values. Who would have known, right? 2 decades of skyrocketing prices. You could say you're a really smart investor, but really it all came down to super low interest rates. If you had to get to a certain net worth, call it 20 million. So I'll just tell you my actual net worth at the time, like what I wanted to do. My plan was to get to $20 million worth of net worth so that if you put it in a 5% bond somewhere or just got 5% return, which is very easy to do, and you can do it very safely, then you would net $1 million a year. I mean, it would be gross. You'd still pay taxes on it. So it would be the net amount that you would get. But 5% of 20 million invested into the markets would relatively safely get you $1 million a year, which is great for being, passive, right? Full passive income. But it sounds a lot easier than it actually is to get there. I mean, if you think about it, like how many people do you know got to $20 million net worth? I mean, I'm sure maybe you know 1 or 2 people, maybe not, or maybe you read about them. If you had to do it from scratch, how would you do it? Like you can't save your way to the top. Like you'd have to buy $20 million worth of properties. So how do you do that? So you buy $21 million properties, or you could buy 10 $2 million properties, or you can just do a combination of that somehow, right? So how I did it was that, you buy your first property and it went up in value. So my first property was in 2005, 20 years ago, and it went up, like it pretty much doubled in a few years. So what I did was I refinanced out, took that money and spread it again. And then of course it went through another series of doubling. So I thought, oh, this is pretty awesome and pretty smart. So I doubled it again, right? And this time on the 3rd try, I took out my money and I spread out to 4 condos. At the time I bought 4 condos, which was in hindsight, not the smartest thing to do. I had a smart accountant tell me that was pretty dumb because it's all eggs in all one basket. If you hit it, great. If you don't, you don't, right? The whole point is you buy $20 million worth of properties and then eventually pay them off over, in theory, 25 years. What could go wrong, right? But then you realize that interest rates hit this year. So the reality, if your property doesn't cash flow, well, you're gambling on the market instead of actually investing. So I used to think cash flow was not including financing, because really you can make anything cash flow just by paying it off. I mean, it sounds easier than said than done, but really if it was cash flow negative, I wouldn't mind so much because my day job, which just so happened to be in real estate sales, but if your day job wasn't in real estate sales, it was a totally different out of the industry altogether, and you use that to pay down negative cash flow, in theory, you can keep it going as long as you hit it 25 years later, then whatever you built your net worth to be, your property worth to be, that would be your net worth. And of course it goes up, it goes down, but for the most part it should go up because of the debasement of the currency, right? So we know that it's going to be guaranteed. If the inflation's at 2%, then your property's going to inflate at 2% per year. It's simple, right? But ultimately, I think you need to make sure that you have something that's cash flow, that's sustainable, and that you're not bleeding out and relying on your day job to pay for that. To a certain degree. I mean, if it has a bit of negative carry in times like today when interest rates shot up, yeah, then you'd be able to stomach that. But if it's too far, too gone, and you have so many properties that are just crazy negative cash flow, then it's going to hurt. So a key takeaway is that you want to look for deals that make sense today and not just ones that might make sense tomorrow. Lesson number 2, leverage can build or break you. I know it sounds obvious, financing helps you scale, but too much leverage can wipe you out. And, in the past when interest rates were at 2%, maybe 3%, it wasn't so much of an issue because we've had this for 20 years. But now in 2022, when rates started shooting up from 4% to 5% to 6% to even 10%, depending on what you qualify for, that hurts. That really does hurt. A lot of investors almost got wiped out. I'm sure some of them actually did. When interest rates rise, cash flow tightens, and over-leveraged investors are forced to sell at the worst times. That's the things you don't think about, right? When the rates go up, prices come down, and you can't hold on. Well, then I guess what? You're selling at a bad time. I've seen investors go bankrupt. It's pretty sad because they stretched themselves too much when the market was hot. So that's another lesson. I would just like make sure you have enough down. I know it's easy to say if you're just starting out, maybe you want to think about saving a little bit more before you enter the market because a lot can go wrong throughout the whole journey. And I'm not trying to scare you off. I mean, if you're living for yourself instead of paying rent, well, just factor the fact that maybe you're paying a little bit more in your payments, or you stretch out your amortization so you actually get into the property ladder. And if you're living there, you don't make the payments. If you're really stretching yourself too much, don't do it. It's not worth it. It's a lot of headache and a lot can go wrong. Another thing I might say is that you can partner with somebody that has equity so that, if there's two or more of you, a group of you guys buying, then, you have enough liquidity to make it through the rough times and actually use a lot less leverage as possible. Lesson number 3, cheap properties aren't always good deals. So when I first started, I thought that cheapest deals were always the best ones. I learned the hard way that the lower the price, the higher the risk. Cheap properties often come with bad locations, bad tenants, high maintenance costs, or slow appreciation. $100,000 discount doesn't mean much if it costs you $200,000 in headaches, vacancies, or repairs. I would focus on value, not just price. So don't go invest in areas that you're not used to, that you're not familiar with, areas that probably won't appreciate because there's not many people there. And that's the reason why they're cheap in the first place, right? A solid, well-located property at a fair price is often better in the long run than an investment bargain in the wrong area. Like I bought property really far north and during the pandemic, right? Like it wasn't early on, but just recently I bought it in the pandemic outside of the GTA because people thought that they would move out there and things were going hot and, why not? Like I didn't see it coming down. But in the back of my mind, I just knew that eventually at some point people would have to go back to work and then the property market might come back down. And guess what? It has. So I haven't lost my shirt yet, which is good. It's just gone back down to what I bought it for. But you know what? I'll hold on. I'll just wait and I'll just let it pay itself off because, got enough equity already as it is. But look, I would never buy something out of town like that again. It's just, there's no renters there, not the good ones anyway. And you have to really take your time to find a good renter. Yields might look a little bit better when you get somebody good, but it just might not be worth the headaches. So these are 3 of the biggest lessons I've learned in 20 years of real estate investing. And if you found it helpful, just hit the like button, leave a comment. Or if you want to talk one-on-one, there's a button in the link below just to book an appointment. We can have a 15-minute conversation about your situation. And I can tell you some more lessons because I've learned more than 3 things. There's like a lot of lessons I learned over 20 years of investing in real estate. All right, thanks for watching. Talk to you soon.
Add it up.
Thanks for sticking out to the very end. I hope you got some value out of this. Do me a favor, please press like and subscribe, but more than anything, leave me some feedback so we know what to produce for you going forward. Thanks again.